guys? Good morning. Welcome back to another pre-market live stream here with the Everyday Growth Advisors. Hope you're having a good one. So we just had NFP come out and the unemployment rate for the week. We've had pretty interesting job reports for this week, both pointing towards the fact that the job market is starting to cool just a little bit. So let's kind of talk about it and kind of break it down so you guys can understand what exactly is going on. So NFP came in at around 311,000 versus the consensus of 225,000. Now, the last NFP reading that we got in the month of February was much higher, and that was the January non-farm payroll. So that number was at 500 plus K, which means that there were significantly a lot more jobs added to the economy. But right now, this round, we have about 311,000 versus the consensus at 225,000. So that still suggests that obviously the labor market is still a little bit tight. But however, the main thing that changed here, which is the most important, arguably the more important thing, was the unemployment rate, which unexpectedly went up to 3.6% versus the consensus of 3.4%. Okay. So based on what we are looking at in the job numbers this morning, it's kind of showing us that, okay, the disinflationary effects of the market are finally starting to kick in. Not to mention, also on top of that, you had the hourly earnings kind of falling just a little bit, which is good news, right? It's fallen by like a couple of cents. So I think the best way to interpret this data is that the tightness of the labor market is starting to kind of calm down just a little bit. Okay, is that good or bad for markets? That's obviously can be viewed positively, but it obviously makes the likelihood of a 50 basis point rate hike from the Fed a little less likely. In my opinion, it makes it less likely that the Fed will hike a 50 basis point rate hike because it shows that their effects are already working. So a 25 basis point rate hike will be, I think, more appropriate rather than a 50 basis point, which will actually really shock the system. So I think for right now, this is obviously my opinion, my personal opinion, based on my experience in markets. The market might be overpricing the bad news right now. And so if we do get the idea that the Fed comes in with a 25 basis point rate hike, that's actually going to send the market up instead of down. But a 50 basis point rate hike will pretty much be priced in at the meeting. So I think both ways, this kind of puts price action in a win-win situation, set up to have asymmetric risk, more skewed to the upside rather than the downside. Because the market's pricing in the worst opportunity or the worst possible scenario. Now let's talk about a few other things. What happened yesterday, and then how do you make sense of everything? So yesterday we had some news about the SIVB Bank, Silicon Valley Bank, unable to fulfill some of its payment obligations and had some credit issues, and then that spilled over into the entire financial sector because investors started selling off bank stocks, pretty much sector wide, in a wave of fear that other banks would be affected by this, and some kind of a systemic risk was approaching. But to me personally, I don't understand why. Like it doesn't make sense to me why stocks like JP Morgan and Goldman Sachs would be sold off so aggressively. Well, Goldman wasn't sold off so aggressively, but JP Morgan was sold off more aggressively. Perhaps they have worse financials than JP Morgan. But this was a little bit of an irrational move by the stock market yesterday. In my opinion, does not reflect the current situation in the financial sector. If anything, I think this is overdone a little bit. And I think that, if we can get down into 128, 129 here, I'll be happy to take some upside exposure on both of the strongest banks, which are JP Morgan and Goldman Sachs here. Goldman Sachs, especially at around the 340, 339 level, which is kind of where we are, is a good spot already if we can get a bounce to the upside. So I would be happy to take some exposure on both of these. They are the strongest ones, in my opinion, based on balance sheet wise. Now, here's the other thing. Yesterday's move down on the market was asymmetric. You would realize that tech didn't actually move down that much. You look at the move on NASDAQ versus the S&P 500. The S&P 500 broke its previous lows the local lows, and then came back all the way down to make a trend, a breakdown of the trend, and kind of reverse. So this was kind of, it moved from going into an uptrend into a potential downtrend. Now, what would negate this and send it like pretty much continue this to be a downtrend? Well, we have to reverse very strongly within the next couple of days, either 1 to 2 days more. We need to reverse out of this level here and start making our way back into this upward channel ahead of next week, which is a good time for me to talk about next week, because I think you guys should start prepping for the week ahead. Now, next week we have a slew of events. The first event being that there's going to be CPI released, okay? There's going to be CPI released on, I believe it's Tuesday. Let me double check. Yes, Tuesday. So here's all the data that's coming out next week. You have CPI on Tuesday, okay? And then you also have PPI on Wednesday, okay? Remember the last time the market didn't move on CPI, it moved on PPI. It did move on CPI as well, but PPI was more of the thing that sent us down, right? Then you also have retail sales for advanced retail sales, and then you have also initial jobless claims next week. Okay, a lot of economic events. Then let's see. After that, you have building permits. That's another one, right? All in the same week. By the way, mind you, should I add that this week is also a quad witching week? Okay, what is a quad witching week? Does anyone know? A quad witching week is where 4 types of options expire for the quarter. It's a quarterly expiration of options. And this specific next week, we have 2.8 trillion, yep, $2.8 trillion worth of options that will expire. Okay, so next week, a lot of delta and gamma is going to be unclenched. What does that mean? And I've explained this on previous live stream before, right? The dealers are going to have to move their positions around. They're going to have to roll their positions. They're going to have to unclench their positions. So if they had exposure on the market, let's say abrupt downside exposure or asymmetric upside exposure, they're going to have to roll those contracts into further expiries. Not only that, they'll have to adjust their exposure based on the market risk, okay? Based on where the price action is. So think about it like if you were an options trader, right? If you had all of your exposure at 4,060 calls, for example, and maybe you had very little exposure to downside, you would have to move, or you would have to roll your contracts. You would have to maybe take some more contracts closer to this way, or maybe go further out this way, right? Go further down in your exposure. You kind of get the idea. So dealers have to do the same thing, except for their exposure is a little different. Their exposure comes from people who place trades with them, right? When you place a trade, where's your trade going? Your trade is going to the dealer, the market dealer, or your broker. It's synonymous. Market maker, broker, market dealer. These are all the same names for the same person, right? So when you take a call, they have to take a put. That they take that risk on. They have to offset that risk off, right? How else are they going to be risk neutral? Otherwise, whoever who places a trade with them, they take on that risk for that person, right? They don't want that. So they have to adjust their risk, and that's what we call unclench, okay? Unclenching. So next week, with all that unclenching, you can bet your ass that a lot of this price action is going to become very volatile, because there will be some people who have too much upside exposure, some people who have too much downside exposure. But I'm going to say it, and I'm going to say it once again. OPEX weeks are not the week to apply risk, okay? I've said it on the live stream like 500 million times, so I'm going to remind you guys. Today is Friday, the 10th of March. I'm reminding you guys that next week, trade lightly, okay? Trade very lightly next week. It is not a week to apply unnecessary risk. It is not a week to even speculate. So don't speculate, because let me tell you what's about to happen. This is about to happen. We're going to get a lot of this and then a lot of that. A lot of this and a lot of that. A lot of this and a lot of that. It's going to be a lot of sideways movement. And if you're an options trader, that's going to be hell for you. Until and unless you are extremely proficient at what you do and you know exactly what you're doing, I recommend that next week, take the damn whole week off. Take the whole week off. Seriously, you will not lose anything. You will not lose any opportunities. Okay? You come back the next week after that, I guarantee you the market will be still here and nothing, like not much would have changed. Okay. In fact, you would have a calm mind and you would thank yourself for not doing yourself a disservice. Okay. So I'm telling you guys way in advance that next week don't apply, unnecessary risk. In fact, for me personally, I will not be trading much next week. I'll focus on other things for our webinar. Like for example, like just work on your own other stuff, right? Which, by the way, this might be a good time for me to kind of announce the webinar. So let me just actually quickly do that so that you guys are aware. So we asked a bunch of you what you think we should hold a webinar on the webinar topic. So let me just give you guys a little update. We're going to be holding a webinar on the 26th of March. To sign up for the webinar, go to our IG, click on this link right here. In the second link from the top, 326 webinar sign up, click on that. Put in your first name and your email address right here and reserve your seat. Okay, that's how the webinar sign up is going to work. Now, in this webinar, I'm going to do about a 15-minute update on 2023 market conditions. This is going to be a macro and technical update. Then, for about 15 to 20 minutes more, we're going to cover bond markets, okay? What bond markets are, how bond markets correlate to assets like stocks. I'm sure many of you, sometimes you hear things like, oh, the 10-year yield is here, or the inverted yield curve, or, I don't know, there's a lot of lingo, financial lingo that you might not be familiar with relations to bond market. I'm going to cover what all that lingo is or what to understand about the bond market. We'll take about 15 minutes to do that. And then maybe another 10 minutes, I'm going to concentrate on some behavioral finance topics. How do you trade with a clear mind? Okay. I have some really interesting key tips for you guys, and I hope that it will be helpful. Then I'm going to leave the last couple minutes for live Q&A where I'm going to open it up for questions. So make sure you sign up for this webinar. It's super important. I'll probably prompt you guys again when we're closer to it, but I highly recommend you guys to sign up for the webinar. Okay, great. So I needed to mention that because obviously it was linked, right? So let's jump into the technicals a little bit here. Now to discuss the macro, we jump into technicals. Now, today we really need to try and climb back over this 3940 level. This 3940 level has been a really important level for us. As a support. We found a lot of support here, and yesterday we broke through it. If we continue rejecting this level today and we break below this 3882, that's going to send us down into 3780. Okay, 3781, 3780. This is not going to be a very good look, okay, for the market. That means that we would have broken into a downtrend. Okay, so we would have been going from an uptrend where we were into now a downtrend, and then we would have to retest a few levels and then see where we go from there, right? So it really all depends on today and next week's price action to give us some light on the situation. But in my opinion, next week brings a lot of opportunity for the market to squeeze back up as well, okay? But as always, remain unbiased. Whatever you see is what you trade. The price action is king. So try not to be unbiased. Try not to be biased. Okay. I know I sent out the newsletter saying the bull market is back, but if price action tells me otherwise, I will hop back into puts if I have to. Okay. I will not be stubborn and sit down and bang the table and put my ego so high to the point to say where I can't say that I was wrong, because that would make me a fool. Okay. Remember that there is nothing worse than somebody who has a high ego and not admitting that they are wrong when they are wrong. But right now we are not there yet. So when we have further developments in price action, we can know more about this market, right? But for right now, it can go either way, right? It can really go either way. One daily candle broken below and holding below is not enough to send us completely down. We need to see multiple candles here. Today might end up being a chop day. And then maybe on Monday, Tuesday, you have CPI, then, something may happen after that. So, there's a lot of things that are going to happen. And don't forget that at the end of the next week after that, we have the Fed meeting, which is FOMC. So a lot of things can happen between now and 2 weeks from now. This next 2 weeks is going to be insane. This is the reason why I said today's live stream is super important to attend. Not many traders think in advance of what the events are. And this is one thing about planning your risk management. It's understanding what are the events that are lining up. The market's always forward looking. You need to understand that. So if you know what's coming up and you're planning ahead for it, you're gonna see, okay, these are all the possible scenarios. Like, okay, we could head up to here, we could head up to there. Why is the market feeling this way? Why is the market feeling that way? Right? So I always like to tell you guys and keep you guys on your toes so that you know exactly what's going on. And I hope that's one of the benefits of attending this live stream for you guys. So I really, really hope that you benefit from it. You know, if you do benefit from this live stream, I would really love to hear from you guys. Honestly, you know, nothing brings me more joy than to hear from you that something that I say or this consistency of putting out these videos for you guys are helping you guys. In fact, it motivates me to do more for you. Sometimes I feel very lonely in this job that I do because personally, trading to me is a very lonely journey, and that's the reason why I have a community that I have built so that I can help other people and feel of use. And to be honest, you know, when you come to the point where I am, not saying that, you know, I'm very successful or anything like that, but when you come to the point where I am, it becomes a extremely lonely journey, in fact. And I'm very focused on my own agenda, you know, my own things that I do. So therefore, I love to hear from you guys and hear the positivity and motivation to continue putting out these live streams. In fact, sometimes I wonder to myself, you know, should I continue putting out the live streams when we have, you know, just 20, 30 people who consistently turn up? But you know what? I do this for the 20, 30 people who consistently turn up. And I love every one of you guys for turning up. I really do. Even if we have 20 people here, it doesn't, you know, make me sad that we're not growing to 100 or 200 or 1,000. Because at the end of the day, it's about me prepping myself for the day. I'm being real honest with you guys. For me, this process of going through a live stream with you guys, it helps me prepare myself for the day, and that's beneficial for myself. So I don't mind sharing everything with you guys, whatever that I analyze, whatever that I'm thinking, I put it out there for you guys so you can learn too, right? But yeah, you know, I love it that you guys turn up, and obviously, you know, the best thing you can help me with is to smash the like button, because then hopefully YouTube will recommend the video to somebody else, and you know, they'll maybe, even if 2 more people, attend the live stream per week, and those 2 people see what we do here, and it's so much more value than what the regular live streams I see people put out. Even if I can change 2 people's lives more per week, that's a great thing for me. I love, you know, receiving those messages from you guys where you say, you know, my life has changed. You know, it's nothing better than that for me personally. So I want to, you know, once again, thank you all from the bottom of my heart for attending. You guys don't understand how much it means to me. It's a small group that we have built over time, but it's a consistent group, and you know, there's nothing more that means more to me than your success. Oh damn, I went on a very emotional rant there. I'm gonna stop now. I might have to start crying. I'm just kidding. Okay, so let's get into technicals of other things here. Okay, so two other things that I'm watching here that are really super important this morning. First up, bond market, right? 10-year yield. In fact, look at this. So the 10-year yield's coming down, you know, after that jobs report and after yesterday's events, you know, kind of showing that people are actually starting to get into bonds now, which is, okay, that's a significant development in the market, right? So this actually relieves the pressure on equities a little bit, right? Remember that the 10-year yield, the higher it goes, the more downward pressure on valuations it creates. And so if the yield starts to drop, then this relieves that pressure, right? It relieves the pressure. The funny thing is, you know, just last week, a lot of the news was cycling bearishness. They were saying, oh, you know, oh, we're all going to die, you know, the 50 basis point rate hike. And then now, you know, this SIVB thing happened yesterday. So the news has been cycling a lot of negative headlines. And this actually makes me more bullish. Because remember, whenever the market gets more pessimistic, I always take the approach that this is a good time when people are fearful and panicking. And this is where you take advantage of the market's irrationality. And now I get some added confirmations here, one thing being the bond market, the 10-year yield, right? The 10-year yield coming down here is good for equities. Then on top of that, you add another thing, which is the dollar index. The dollar index broke out briefly out of the 105 level, and it wasn't able to exactly hit its stride. Now, I'm saying this prematurely because we're still in the uptrend here on the dollar. But if the dollar does end up coming down here very abruptly, and then, you know, starts to break down below this 104.60 level, and then this 104 even level, right? That's going to further energize this equity rally, the possibility of an equity rally, right? And remember, I'm not trying to be biased here to the bullish side. All I'm saying is recognize what's happening in the market. These are just early signs. You need to be able to read what are the precursors to price action, right? And I always tell you guys, always follow what the bond market does, because when the bond market sniffs, when the bond market sneezes, the whole market gets a flu, right? So you need to be ready to analyze these things. So dollar coming down, also remember that exacerbates the valuations of stocks, right? It makes it better, okay? Okay, so yesterday, financials got hit heavy, right? I personally think this is irrational, but then at the same time, you know, this is the most important thing to view here is when we are going to bounce from here, right? We smacked all the way down to the 61.8 extension. This is very peculiar, right? So I'll be waiting for a potential bounce here. If we don't get that bounce, then the financials will fall further. Now, one of the reasons why this move down yesterday was so aggressive and continues to be aggressive because of, you know, is because of the financial sector, right? You have to always remember something. What does the market constitute of? Look at, you know, the biggest sectors within the S&P 500, the first being technology. The second biggest sector is financials. And this is the reason why you will see that yesterday, because of financials, the S&P 500 dropped more, and the NASDAQ recovered, or sorry, not recovered, but it didn't drop as much, right? And even this morning, you're seeing the same thing. So even though NASDAQ didn't get further down and make lower lows, the SPX broke down and made a low here, right? So when this whole thing reverses, what do you think is going to come out stronger? It will be tech, right? It will be tech, okay? Anything NASDAQ related will be stronger on the rebound. So I'm trying to get you guys to think ahead here, because thinking ahead is the most important thing in the stock market. If you are chasing something in terms of price action and you know, you're like trying to get on a train that's moving, very less likely that you will catch it, okay? So that's all I have in terms of breakdown today. Let me read some of these comments. Stay cash without any clear direction. Yep, that's right. Awesome, T-Buy, no problem. Yep, gotta smash the like button. Yes, please do smash the like button. Please don't stop. Really appreciate it. Hey, Steven, I will never stop. Don't worry. Even if there's 10 of you here, I will never stop. Helps me. Thanks. No problem, Rich. You're changing 20 people's lives. Can't ask for anything better than that. Exactly, Garrett. That's exactly what we do. Monday, Wednesday, Fridays are the best start to my mornings. Always smash the like button. Thank you, Eddie. Your webinars are what got me to take trading serious. Oh, wow. Okay. That's awesome, dude. Carlos, I'm glad. You break down the economic events so we don't got to. Much appreciated. Yep, that's what my aim is. And honestly, there are very few people who understand macro. I'm not going to say that I understand them very well, but I mean, I do have a master's in finance. I would hope that I can explain this stuff, right? But yeah, if you guys have any chart requests, put them down here right now, because if not, I'm going to end the stream right here. And I hope that you guys have a great weekend. I'll wait like a minute and see if anybody wants me to break down a specific chart. Yeah, SIVB, it's down a significant 62% over pre-market. And this thing obviously is gotten halted by SEC based on the trading guidelines. So pretty much hit like a circuit breaker. But yeah, this thing is absolutely demolished. Don't know if this will spill over the market in terms of systemic risk, but I think not. I think not. Quickly, Tesla, possibly another bounce before Gulag. Yeah, let's have a look. Okay. So Tesla, next pivot level is going to be 167.35. This is based on the previous support level here. You can see back in November 22nd, November 22nd or 23rd, this was the previous support right here. So this is going to turn into support once again. That's around 167, basically 167 even, or 167.30, somewhere around there. So this is going to be a good spot for Tesla to kind of magnet towards. But yes, I do agree with you. I think possibly a mini wave up. It might even get up to around 181 or 182 to retest before coming back down. But the thing about Tesla, another thing that I do tend to see here is a lot of the times, sometimes the move up could be not as aggressive. So maybe, a move up to 177 could be another rejection here. So I would look at some exposure, possibly halfway through the move if you're really feeling frisky about taking a short position on Tesla. 177, 178. See if we can get a rejection. I think the most important thing here will be to look for that reversal price action, some kind of a pin bar, some kind of a long wick candle on a bigger time frame, maybe a 1 hour time frame, maybe a 15-minute time frame. See, like something like this, with that big rejection and then that big bearish candle. That's a very key telling reversal signal kind of thing, right? So you want to look out for things like that on Tesla, but somewhere up here pretty much, right? So maybe around 177, 178, that's the level you want to look for retracement and rejection right here. That's what I would look. Yeah, it's already at like 175 pre-market now. So what is your outlook on regional community banks now? QABA is an ETF I have in my long-term account. Okay, let me see, what is QABA? First Trust Nasdaq ABA Community Bank ETF. Okay, so here's the thing. In terms of systemic risk, I don't really see the... Okay, I do see... The thing about SIVB is I read somewhere that it was one of the nation's 16th or 17th biggest banks. So we're looking at like a smaller bank that got blown up, right? And obviously, you got to also read into why this happened. They kind of made error with their lending rates. That's what kind of happened with it. I was reading. I took almost like, I want to say 3 hours to read about what happened behind the entire thing. I would say it's kind of like, okay, it's not an Enron scandal, but it's Enron-like scandal. Basically, not like Enron level, but like somebody messed up in terms of their underwriting, right? And they basically started loaning at a very low interest rate, and then the people who they were charging at low interest rates, they started borrowing capital like no tomorrow in this current increasing rate environment. And now that they did that, a bunch of people are holding those loans and trying to call them back at a time when interest rates are higher, which caused the entire debacle. So I don't know if that really spills into the rest of the market. I mean, we've seen crises like this happening many times, but I feel like it's a very isolated case, and I think that the sell-off is very overdone. And when I say overdone, I mean that there's a fear element that is drowning into this. And it doesn't mean that it's not going to affect other banks. And what I'm saying is I don't think it's a systemic event that will affect equity-wide. That's what I mean. In terms of this specific ETF that you hold, I mean, it does look like it did affect it. So if it gets below this 47.97, what you might want to consider doing is buying some short-term hedges, buy some puts, right? And since it's listed on a NASDAQ, you can just go NASDAQ puts, right? You can go QQQ puts. So yeah, that's what I would advise. Hold some puts in the short term. Easier that way. All right, well, time's up. Market's open. I'm going to jump on the Discord with the team. Remember, guys, you can still sign up for the free trial and be a part of our Discord absolutely for free, and then cancel and don't get recharged. So I'll see you on the trading floor if I see you, but I'm going to end the live stream here, and I'll see you guys back on Monday. Have an absolutely great weekend. Take care, and I'll see you guys soon. Peace.